Hey everyone, welcome to our live roundtable here talking about lending in the cannabis industry. Thank you very much for joining us. We're a little bit before we're going to hop into the main part of the presentation here, but if you are watching on replay, please skip ahead a few minutes. But aside from that, if you are live, please let us know where you're calling in from, what vertical you're in. Maybe you're an ancillary service provider, a grower, a cultivator, a retail person. Please let us know. And lastly, let us know anything you're looking forward to seeing in today's presentation. If there's any questions you have regarding lending, financing, or banking, please drop those into the chat of the preferred platform that you're on, because questions will help us guide this presentation to make sure it's the most valuable for you. But we'll get started here in about 10 to 15 seconds. I'm just gonna check every last little thing here. All right, let's close out Slack. All right. Just make sure all settings are good here on my end. All right. Yeah, and if you're not a platform, YouTube, LinkedIn, please let us know where you're calling in from. Drop into the chat. We want to get as much interaction, make this valuable for the people on the live stream here. We got a lot of people filling in here. Excellent. All right, so let's go ahead and let's get started here. Before we get started, I need to let you know that the information contained in this presentation is meant for guidance purposes only and not as professional legal or tax advice. And further, it does not give any personalized legal, tax, investment, or any business advice in general. So first, I'd like to thank you for joining our roundtable on lending and finance in the cannabis industry. Today, we're joined by many experienced panelists from a variety of disciplines specializing in the cannabis industry. And you can find the links to all of their websites in the description of the YouTube video. So please make sure to check them out, and a replay will be sent out tomorrow. Now, our goal is to deliver a ton of value and help you to better understand the intricacies of acquiring loans in the cannabis industry as a cannabis business. My name is Jim Breese. I'm from GreenGrowth CPAs, and I'll be covering the chat and moderating today's roundtable. And the panelists you see on the screen in front of you. Panelists, thank you for joining us today.
You're welcome.
All right.
Thank you.
Hey, excellent, excellent. So let's go ahead. I want to go over a quick agenda so everyone has some context of how this is going to be run, and then we'll go from there. So first, I'm going to do some introductions, and then from there, we're going to do a series of 4 7 to 10 minute chats with each of the panelists here. First, we're going to chat with Jeff on lending landscape and preparing your cannabis business for financing. Then we'll hop over to chat with Dan on long-term, low-interest loans for cannabis businesses. Then we'll hop in and chat with Mel, specifically on the importance of establishing cannabis banking relationships and compliance. And then finally, we'll round it out here with Scott with common mistakes when applying for lending and how to improve your chances of getting funding. As well as, again, we'll take questions from the audience between each chat and at the end of the session. Our target runtime here is about 1 hour. So without wasting any more time, let's get right into the introductions. So now I'd like to have each panelist introduce themselves. We're going to go in this order: Derek, Scott, Mel, Dan, and Jeff. So please, in 1 to 2 minutes for each panelist. Derek, to start, tell us your name, your company, your experience, the services that you provide or specialize in, and lastly, if you have a little knowledge nugget about finance or lending in the cannabis industry. So Derek, why don't you go ahead and kick us off here?
Yeah, definitely. Thank you so much for having me on today, Jim. Really, really appreciate it. I'm Derek. I'm the founder of GreenGrowth CPAs. We're just really excited, grateful to have all these amazing panelists, and just excited to learn more. We always have so many questions that pop up as it relates to lending, and so just really excited to be here. Thank you again, Jim.
Excellent. Now, Scott.
Yeah, my name is Scott Jordan. I've been helping the cannabis industry since 2009. I run a company called the Alternative Finance Network, and as the name indicates, we provide a network of lending choices, starting with banks, credit unions, life insurance companies that help cannabis business owners obtain debt capital for real estate, equipment, working capital, sale-lease-back, etc. We've completed over $100 million of loans in the industry since the inception, and are really looking forward to 2022 as being a great year for expanding the growth in the industry and helping cannabis business owners get the debt they need without having to give up equity. Thank you for having me, Jim.
Excellent. Thank you. And then Mel, let's hop over to you.
Thank you. My name is Mel Barnes, and I am with Westtown Bank and Trust. Westtown provides services to the industrial hemp, CBD, and cannabis industries. We do not provide any lending at this time. I come from a community bank background and have been in this cannabis space for about 3 years now.
Excellent, excellent. Thank you. And then Dan, thank you for joining us with your video. Got that all set. I apologize for the wire here, but Dan, please introduce everybody to yourself, your name, your company, the services you provide, things of that nature.
Certainly. Thank you very much, Jim. My name is Dan Page. I run Boulder Equity Partners, LLC. We're a nationwide commercial lender, have been for many years. As part of that, we also fund cannabis properties, means dispensaries, cultivation, processing, research, and they're really in those typical asset classes like retail, light industrial, warehouse. We have 5, 7, or 10-year terms, have a low interest rate of 6.49%, can fund either owner-occupied or leased, ranging from $1 million up to about $10 million, and also have a bridge program. We can fund up to about $4 million.
Excellent, excellent. And then lastly, Jeff, could you let us know a little bit more about Arcview and your role there and anything else you'd like to provide for us here?
Yeah, sure. I'm the founder of Arcview Capital. Arcview Capital is a SEC FINRA registered broker dealer. We're a boutique investment banking firm, so we specialize in crowdfunding, private placements, so 506c raises, for example, M&A work. Do a lot of M&A work, as well as IPO advisory work. And in the next 6 weeks, we'll be launching with a partner a REIT that specializes in cannabis properties.
Excellent, excellent. So we've got a lot of panelists across a broad spectrum, again, of different disciplines and different things that they specialize in. So thank you very much. We've got some good questions coming in here from the chat. But first, we're going to jump into a one-to-one chat with Jeff and myself here. So let's move over to that here. A little background on Jeff. Extensive background in securities industry, 17 years with FINRA, AML investigative management experience, and in his past life, he was a licensed CPA. I read on his biography. So welcome, Jeff. Again, thank you for joining us here.
Thank you.
Yeah, so we've learned a little bit about Arcview, what they do from your introduction. So I wanted to jump into the discussion about your perspective again on the lending landscape and the process of making your cannabis business funding friendly. So let's go ahead and talk in. The first question here that I want to discuss is, you see the cannabis industry is always changing. It's growing. It's evolving. This is a common thing we hear a lot about, but I want to get your help in characterizing and crystallizing some of the specific changes on the lending side of things. So could you help us to better understand how the lending landscape or finance landscape has changed over the past 18 to 24 months? And this could be in terms of deal flow, deal terms, opportunity shifts, interest rates, ability to raise capital. I want to leave it very open so you can kind of give some color and context to what you're seeing.
Yeah, I think, if you look just 2 years ago, there were very few firms out there that were in the broker-dealer space that were helping cannabis companies. We're actually probably the first that went to FINRA and requested for approval, not just to do investment banking in the lines of business, but we out and out said we're going to be in plant medicines, hemp, psychedelics, and cannabis. Within the first week, they told me they weren't going to approve us, even though I had 17 years experience. And we quickly got them back around. And I think it's important to understand that there's been a void for a long time of having real financial services firms in this space. That has changed over the last 2 years. And so what we bring to the table is we have a group of people who came from the regulatory side, right? And so we understand what people are looking for. I think the regulators got comfortable because we understood that we needed to add extra compliance and regulation to what we do, and therefore our due diligence process might be a little bit more robust than you'd see at a traditional investment bank. Mm-hmm. And that's to make sure that we're putting out the best product for our investor network, and that the issuers have the most chance of success.
Excellent, excellent. So you got probably a good amount of pushback when you opened up this firm. It sounds like it's like, oh my goodness, you guys are giving money to people.
Cannabis.
Yeah, oh my goodness, you're funding these kind of activities, but no, it makes sense. So then, let's talk about fundable businesses or fundability, the fundability overall. From what you're seeing, are there any types of businesses that are becoming more attractive in these spaces? Specific verticals, or they have to be fully integrated? Are MSOs more preferred? Or do they have to have certain assets like IP or real estate to really have fundability as a metric for them?
So all of the above. So like revenues lead the way, right? If you've got revenues, it doesn't have to be a positive EBITDA, but if you've got top line revenues already and you're producing revenue, that's a good story, and that will obviously resonate with investors. It's really hard pre-license. A lot of people want to get raised pre-license. That's usually not going to happen. After the license, the question will be, do you have assets, right? Do you have the property already locked up where you can use that to do a refi type of situation or a sale-lease-back, right?
Mm-hmm.
And there's so many different levers you can pull if you have property already in play for the issuer. IP is also important. We look for, if we're looking at cultivators or MIPS, we're looking for people who've already thought about two things, right? When federal legalization happens, you're going to have to be ready for FDA regulation, right? It'll be a few years after federal legalization where those rules will be ready. But what will happen as soon as everything's federally legal, FDA applies. And if the edibles aren't FDA quality, there's going to be a lot of products coming off the shelves in dispensaries around the country. So the ones who've already have the wherewithal to think through that and be ready for that, those products will be able to stay on the shelves and actually capitalize on that, the void that will be created. Second is brand, right? Brands are going to win. Like if you have brand recognition, that's what's going to win after this, after federal legalization. And the fully vertical integrated models, I think, are interesting because, again, if you can control the product, the distribution, and the cultivation, as well as the production, you're self-contained and you control your own supply chain. So those are also interesting plays.
Excellent.
Yeah.
Yeah, and then so you bring up something here about licensing. A lot of people are like, hey, they realize, getting into the cannabis industry, it could be $1 million type of thing, minimum $1 million, for all of your testing and getting licensed and all the other things that come along with it. But you brought up being pre-licensing. I'd like to kind of talk about unlimited license states like California to limited licensing states and compare those to something like Ohio. Now, how would you value a deal or a business that maybe has their license granted in one of these limited licensing states, but it's pre-operational versus something that's a unlimited licensing state like California that is also like the same stage of the business? How do you look at limited licenses versus unlimited license states, and what's the difference?
The valuation on that license is obviously dramatically different in each state, right? Florida is a great example of that. Mm-hmm. We were working on a deal, I think at the end of 2020, just as the Congress voted to legalize.
Yeah.
That deal was for a license that was going to go off for $35 million. The seller pulled it off the table as soon as the vote happened, and they ultimately sold it for, I think, upwards of $60 million. So, wow. Yeah. So licenses in different states have different, because Florida has got, when you have a license there, you've got a region and you've got multiple licenses under it, or like multiple locations. I think we look less about the license now and more about what is the business model, what do your projections look like?
Yeah.
Do you have a good team, right? If you've got people who have proven track records in the space, do you have a path to success? And then can we coach and mentor and help them get to that next level if we help them get the money, right? Our philosophy is not like a traditional investment bank. We don't just raise the money and wave goodbye. We feel like our success is tied to their success, and our reputation is tied to their reputation, and we want our investors to be secure. So we try to stay involved, and we want to also be a feeder for them in the future for the next raises.
Excellent. And so one thing you brought up as well as in the fundability side was having brand, right? Brand is like the kind of that little kicker that can really move things, right? When you have brand recognition. So as you're underwriting or doing these deals, shopping them out to the investors, what is, this stance of like, this is a very good brand versus this is not a good brand? Not in the opinion like, oh, I like this product or I don't, but like what metrics are we looking at to distinguish that something is a good brand? It has good gravitas in the area. It has good pull. It has goodwill that's high on the balance sheet. Are you looking at social media metrics, interactivity metrics, number of how do you measure that so that people don't just say, oh, I've got 1 million Instagram followers that they paid for, I should get funding? So how can we kind of take the noise out and put some real branding back in?
Yeah, I think part of it, we will look at the social media impressions, but when we do our due diligence, we'll ask, have you been using, there's companies like Ubiquitous out there, right? You can go hire the influencers and push it. What's your marketing spend to get those impressions, right? So what's the per capita marketing spend? What actually are units are you pushing, right? That's ultimately what drives. Like, What is the amount of units that you're pushing? That's what's going to be key. And then the story behind it, right? The brand itself might not have a lot of traction yet, but the story might be so compelling that it could become a brand, right? With the right resources and behind it. We have a social equity program, right? And our program is built around diverse owners, women, pride, veteran, BIPOC-owned businesses, and operated. It doesn't have to be a social equity license, but we're gonna really push on those, and we give actually a lower cost of capital to help on those companies if they pass the regular muster of due diligence process. So.
Excellent. So at GreenGrowth, we have this new thing out. We're tracking it's a GreenGrowth Cannabis Index. We're tracking the top 7 in the next 25 publicly traded cannabis companies by market cap. Now, there has been a very pronounced downturn in the valuations of most public cannabis stocks over the past 12 months. It's been painful for some people's portfolio. Some of these businesses are experiencing a slow bleed while others are experiencing major issues. Has the public market downturn at all been a factor in how these deals come together in sense of valuations, projected exit strategies, or any kind of assumptions in the financial models for those valuations?
So what happened in Canada, more than 2 years ago now, really caused a lot of schism in the investing market. I think people are through that, and what's happening currently right now, we're not hearing much chatter back from our investors on that.
Yeah.
But what we're doing is we're looking at deals in a more traditional commercial standpoint, traditional investment banking standpoint, and not giving the inflated cannabis valuations to things. And so if you start to create a reputation where people understand that, now that might not always be a deal for the issuers, right? But if people understand that they're going to get a fair price and that there is a real upside potential, a deal's a deal. And so they'll move.
Yeah, if the metrics are there, the deal looks good, and the due diligence is done properly, then hey, the noise outside and the macro really shouldn't matter too much, to the specific deal. Because when you work in these are local businesses still, they are sometimes across the entire country, but they are very hyper localized on the community that they're serving. So hey, if the market's there and it's demanding it, then it shouldn't be a problem to get the funding for those kind of deals. So now, when talking about due diligence on deals, there are a million aspects to look at, whether it's financial, team, brand, a lot of these other things. I want to hit on maybe 2 or 3 that you can go very deep, not very deep, but just enough to give color and context, maybe demystifying some of the particular aspects, or just pounding down, this is exactly what you need to have as revenue. This is what your margin should essentially, come out to be. In your opinion, what should operators seeking to acquire debt financing be most mindful of in this due diligence period?
So what we do is we generally collect 4 pieces of information on the upfront to do the initial due diligence and make sure companies pass the smell test. Yeah. So the first piece being the pitch deck and/or the business plan. Mm-hmm. I would say the business plan to me is the best tool for a founder to use to really think through in detail their business model and all the things that they're going to need in order to be a successful business owner. And so that's going to be probably one of the key documents, right? Then we're going to look for the current financials. We usually ask for the last 2 years or since its inception, whichever is shorter. And then we ask for the next 3 to 5 years of projected financials. Mm-hmm. We're looking obviously for some hockey sticks. Yeah, right? Maybe not every year is a hockey stick, but there's a hockey stick somewhere on the revenue growth, right? And we're seeing it get to positive EBITDA at least within the first 3 years. And then lastly is the cap table, right? We need to understand what the capitalization table looks like to understand how difficult this deal will be to place. If you've got a lot of existing debt and it hasn't been restructured in a way, because sometimes these the debt will have strikes, right? Like in other words, if you raise that at X level, now that gets converted and causes another issue. So you're going to have to renegotiate with the debtors. And so understanding what that cap table looks like is crucial.
Excellent. Yes, we just put an article about cap tables out recently. Make sure you have a clean cap table because it can really scare away investors when they realize, hey, it's split up 22 ways and there's really no clear leader. These kinds of mistakes that seem great in the beginning because you just want some money, but it can cause so much chaos for growth later down the road. I wanted to take a question here from the audience, and it's about Los Angeles here. So Alexis talks about she's currently operating in LA since 2019. And she says, what if your social equity business is strapped at 51% with your local authority? how do you raise money? Now, I'm not specifically sure on the question, but I think having these social equity businesses, is it harder to raise capital when you're set up with a particular cap table of 51% going to someone? What are your thoughts when you see those types of deals? Because you said you had a whole service line specifically for social equity. Help us to better understand any kind of things around that or context and, things of that nature.
Yeah, look, the social equity licenses, I think the states have caused issues for social equity owners on the social equity license space because of the requirement that in some places it's 51%, some places you have to maintain at least 33%. My personal view is, everybody should be allowed to use their equity any way they want to, but unfortunately these rules have been in place purportedly to protect people from themselves. I don't agree with that policy, but there are ways to creatively structure deals in order to do that. Now that might be through preferred shares, so somebody's getting some sort of interest kickback on it or a dividend on a regular basis. There are ways to make it attractive to investors while still maintaining the 51% threshold. In some cases, I've seen social equity owners decide to essentially convert, get out of the social equity space and come into a traditional license so they can have more flexibility. There are options. And the beauty of our network is we've got Arcview Consulting that can then help and jump in and give some guidance on how to do stuff like that.
Excellent. Thank you very much for that information. Let's pull everyone back in here from the rest of the panel here. Beautiful. Thank you very much. All right, cool. So that concludes our first conversation here with Jeff about the lending landscape and how things have changed. Now I'd like to, again, check the chat real quick. I think there's some good questions in here, but I'd like to jump to the next one-to-one chat between Dan and myself here. And then we'll get to a spot where we discuss a lot of the questions here in the chat. But please keep dropping those questions in here. They'll keep them relevant to the chat here. So let's go ahead and bring just Dan and myself up here. All right. Beautiful. Dan, thank you for joining. I appreciate it. So Dan is from Boulder Equity Partners, and I want to talk about long-term and low-interest cannabis loans for the businesses here, for the cannabis businesses. So I'm just going to jump right to the questions. There are many types of borrowers out there at various levels of fundability. So what type of borrowers are best positioned to get approved for a low-interest cannabis real estate loan?
Sure, thank you. It was really interesting listening to Jeff because our funding model complements his. So he's very much in the early side of the game, and I'm more positioned for folks that are later in their process. And so there's a few different types of borrowers that are going to fit with us. A lot of the folks that we're servicing right now is somebody that took out loans early. So they have high interest bridge loans paying anywhere from 12 to 20%. And they've developed a good profitable business. They have strong financials, strong borrowers. And now they're looking to reduce that cost of capital so they can put that cash right back into the business. Others might have purchased their properties right out of the gate with cash because there wasn't any funding available at all.
Yeah.
And so they're trying to recapture some equity back in their pocket, and so they can put money back into the business again. And thirdly, those that might have purchased properties that have very low loan to value because they bought the properties that were maybe cheap on the market, dropped a lot of increase in value, putting new roofs and HVAC and electric and everything, really bringing them up to par and increase that value. And now it's more than what they originally purchased it for, and they want to be able to pull some cash out again for that growth capital. And I guess the last type of borrower there is someone's buying a new property. We get a lot of that one right now. And that can be a struggle in some cases if someone doesn't have a business already. But quite often they might be leasing a property and have 3 locations somewhere else, and now they're buying a new one and they need cash to be able to make that happen.
For sure. Makes sense. So talking about properties, what types of properties are most likely to be approved for one of these low interest loans? Is it specifically in one of the verticals? Does it have to be in a certain DMA? Does it have to be in a certain population size or certain market, certain types of licenses? Help us to better understand, again, which properties are best for these kinds of loans.
Sure. Well, it's important to look at it from our perspective as a lender. These are just core commercial real estate assets. So a dispensary in my world is a retail property. It might be standalone or it might be part of a strip center, but it's really a retail asset, and that's the way I'm looking at it. Yep. And when we look at either light industrial or warehouse properties, there might be cultivation, processing, research facilities. It doesn't matter to us so much because I'm looking at it as a light industrial or a warehouse property.
Yeah.
And It's in that perspective, what really matters is to think like a lender. What is this? How else could this property be used? Is it in a statistical metropolitan area, so it's close into a population center, or is it way out in the boonies somewhere and it's a farm? And so from that perspective, it's really a traditional real estate loan, which is why it's so inexpensive in comparison with others, because I'm at 6.49%. So what I can't do are properties that are very rural, or we call it a purpose-built property. I've seen some wonderfully built properties that are state-of-the-art cannabis, grow houses, but they can't really be used for anything else. So that's a bit of a struggle for me.
Excellent. Gotcha. So like the repurposing is just not there. So then you're not going to lend against it because, the ability to, pay that loan back if you don't have the operation of the business there is pretty much zero at that point. Correct. So when purchasing a new cannabis property, what should borrowers be considering if they're looking for one of these types of loans? Is there any kind of due diligence things they should be doing? Is there any types of attributes about the property, the size of the team, the type of the business? What specific things should they be looking at when they're trying to buy a property?
Sure. Well, one thing, as I just mentioned, is the property type. I mean, there are lots of wonderful properties out there, but if you're looking for that low interest loan, think about what I was just saying, a traditional real estate asset. So something in or near a major population center that has market comps out there that could be used for another purpose. So that population is important. It's not like it needs to be downtown, but just think about market comps from a realtor's perspective, if there are other properties out there that are similar in that respect. The other thing is loan to value and keeping your feet on the ground. And a couple of things come up there. One is that I run into a lot, and that's market comps, because people come in and buy a cannabis property, and I've literally heard, I just bought this property for $1 million, or I'm buying it for $1 million, and it's really worth $10 million. And I'm saying, well, no, it's not, unless you dropped a lot of money into that property. So try to keep that in mind when you're looking at purchasing a property, about what that value might be to another non-cannabis buyer, because that's how you're going to be able to get that cheap money. And on the loan to value side, probably thinking 65% as a mid-range, anywhere from 60 up to 70% loan to value. So think about having that cash available for your equity for the rest of it. And also improvements. If you're going to make improvements to the property, I know I work with a lot of folks, and they say that to put millions and millions of dollars into their property, but a lot of those investments have been in equipment.
Yes.
Just for the focus of growing cannabis.
Yeah.
And from my perspective as a lender, I say if you bought a property for $1 million and you've put, $1 million worth of investments to the core asset, the real estate, then I'm looking at $2 million that I can loan against. But if you dropped another $3 million into equipment, that's something that's actually personal property, and it's harder for us to work with.
Very good point. Very good point. I want to take a question real quick from the chat here. Lynn Marcello talks about asking, all right, hey, for 6.49%, how many years do those loans go for? And is there any personal guarantee required for those loans?
Sure. No, great question. So I can go 5, 10, or 5, 7, or 10 years. So the borrower choice, rate's the same either way. I have a 25-year amortization, so it's not an interest-only loan. It's a very traditional principal and interest loan. So I have a long amortization period. That term is up to you. There's going to be a longer prepayment penalty with the longer the term, but pretty straightforward in that respect.
Excellent, excellent. And I'll take one more question here from the chat. I think it's a good one here, and it might be it's going to be a complex one, but let's see if we can answer it in a succinct way here. What's the advantage of a sale-leaseback versus a straight mortgage? What kind of cap rates are you seeing with these particular types of deals? And are there any sale-leasebacks with buyback provisions that you're seeing? Have you underwritten any of those kind of deals? Is that typical in the cannabis industry? Have you seen these kind of things? So I'll let you kind of pick apart what you feel to answer in that.
Sure. I do definitely see the sale-leasebacks, and I'm working on one now. One thing to think about when you're doing a sale-leaseback is the profitability of that, of the entity is going to be operating in the property. You want to be able to have consistent, provable revenue behind you to be able to qualify for a low-interest loan. I'm sure it's difficult. It's different rather in bridge and other scenarios. But sale-leasebacks are absolutely doable. I see a lot of them right now. Just the main thing is just having that core revenue and a strong borrower, personal financial statement, net worth, liquidity, FICO. They're really the traditional things you would think about if you're going to buy a home.
Yeah.
So really, if you're looking for that low interest money, there's those core things you think about that you qualify for a loan.
Cool. All right, excellent. And then let's hit on one last question here I have is that what are some of the issues that can lead to a decline for one of these low interest loans here to round out our chat? We talked about all the ways to get approved, but what are some of the kind of the hangups, the mistakes, the sore thumbs that stick out that cause someone to be declined for one of these lower interest loans?
Sure. Yeah, when I work with a client, I have a property questions document I send out, and I ask literally about 24 questions, and a lot of it just so that we can uncover these things on the front end if they are there and try to address them. One big thing that jumps out, we just discussed, are comps. To be looking at what your market comps are. When I say comps, other similar properties of similar value, whether it be a retail dispensary or a light warehouse. And the same thing goes for rents, because if you're buying a property or you own it to lease, and quite often the amount you're leasing for is far above what a non-cannabis company might be leasing it for. And it's great to do a little research ahead of time, maybe talk with a realtor and find out what market rents are in that area, because ultimately that's what we're underwriting to. So it's fantastic that you have strong leases and strong rents and everything, but think about what those market rents are, because that can be a deal killer sometimes. Other property issues that might be challenging for that long-term low interest loan are, again, those non-traditional property, like a farm in the middle of a rural area, or greenhouses are difficult because they're more special purpose properties. And short time in business can be an issue as well. And I'm funding a property right now that the client really just had revenue starting in mid-2021, but they've had that hockey stick that Jeff was talking about, and they have really strong revenues. But if you just started last month or 2 months ago, you're probably going to need a little bit more runway before you get in and qualify for one of those lower interest loans. And that comes down to the profitability, because that's the way it's going to be viewed.
Excellent. So doing things to build trust with the lender, showing that you're actually good for the money, and if you're here for the long term and the business is growing and has some good legs under it. So
absolutely.
Excellent. Dan, thank you very much for sharing your insights on long-term low interest loans for cannabis businesses. I'm sure there's going to be a lot of questions in the chat. I can see some coming in, so we will circle back to those later in the presentation. So let me just bring everybody back in here from the panel, just so we can show things out here. All right, welcome back everybody here. All right, so I just have another question here. I see from Shavnoya is, what's a sale-leaseback? Essentially, a sale-leaseback is when a business owns a piece of property, they sell it to someone or a lender like Dan, and then they lease that property back. It's exactly what it sounds like. You sell it and then lease it back. So you can essentially get some money out of the business here and then go ahead and grow that business using that capital to maybe get more working capital or to buy other assets or the manufacturing equipment or whatever you need for that business. So that's what a sale-leaseback is. Now let me check here the chat on any more specific questions between our discussions here. All right, and then Percy asks, is there any way to speak with anybody looking for funding? Percy, the people on the screen here and on the YouTube channel, you'll find all their contact information. These are the people that you're going to want to look to reach out for that funding. He says he has a project here in Michigan. That's where I'm at. So reach out to the people. They're all listed on the, again, the description of the YouTube video here. So next up, I'd like to bring Mel up for our discussion about compliance and banking in the cannabis industry. So I'll bring us both up here. Again, thank you, Mel, for joining. This is the second time we've been able to chat on some good topics here. You're from Westtown Bank, and again, I want to talk about the importance of establishing banking relationships and compliance. Now, I know this roundtable is focused primarily on lending, but you wouldn't be able to get that money into your business without a bank account. So let's dive right in. Again, Mel and I, we've known each other for a few years. She's been very pivotal in helping many of our clients secure cannabis bank accounts. She works very closely with our client success manager, Lawrence Cajigal. Again, welcome, Mel. Great to have you.
Thank you. I'm glad to be here.
Good. So I just wanted to right into the questions here. As a cash-heavy business, cannabis business operators are at a huge risk of having to secure their money as well as to transact with cash. It's a very precarious position to be in. Can you help us to better understand are cannabis bank accounts any different than normal typical business bank accounts? Why are they seem like nuclear radiation to the only 700 banks that want to touch those kind of? I think I saw a report on LinkedIn just before I hopped on. It was like 750 banks are in the industry, not lending. Sorry, they're in the deposit industry right now. Give us some info on services and how these are different from typical bank accounts, if they are different from Westtown.
Certainly. We don't really look at these bank accounts as different than other commercial bank accounts. There is more due diligence involved. Up front, there is an application process, and we ask questions to get to know your business. We must make sure that you are a compliant cannabis business so that our bank is compliant, basically. And so we do ask a long list of questions. We ask you about all of the things you would anticipate in any industry, plus specific cannabis questions like your licensing. We ask high-level questions about how you operate and maybe your cash handling procedures and things like that give us an idea how you operate your business. A big part of due diligence and compliance in cannabis banking revolves around the Bank Secrecy Act. So, which is an anti-money laundering act. We have to, we really have to make sure that we understand where these proceeds are coming from, and we get those into the bank so that you can use those just as any other industry would expect they could use the funds in their bank account.
Yeah. Got you. So there's online banking, ACH, everything else you would typically know, but there's just a little more kind of like proof of funds and showing kind of compliance things and making sure that this actually isn't coming from some kind of illegal operation,
Exactly.
Sitting under the radar kind of thing. Excellent. Excellent. And then, which states does Westtown Bank and Trust currently support for getting bank accounts for cannabis businesses?
Well, there's really two different groups of people that we bank in the cannabis industry. And those are the tier 1 accounts, which are plant touching. So if you're growing, manufacturing, perhaps, any kind of distribution, whether that is, moving product, wholesale product, or if you are in retail, those are tier 1 accounts. And so those are a little bit trickier than some of the other supporting companies in the industry because they are cash heavy. And cash is a monster. Cash is expensive for so many reasons, and it has to be handled and traced and tracked. And so those types of businesses who are cash heavy, we can bank in California, in Colorado, Montana, New Mexico, Oklahoma, Michigan, Ohio. We've picked up some accounts recently in the DC area. And what determines where we are banking these accounts is we have to have a relationship with Armored Car, with a cash courier who can handle those funds for us. And so strategically, we have established vaults in different Federal Reserve areas where we can accept the money for deposit. Now, on the flip side of that, if you are not a tier 1 cannabis operator, if you are just supporting the industry, tiers 2 and tier 3 typically are not very cash heavy. And so those folks are easier for us to reach and provide services to because we don't have the additional problem of the cash and handling that cash.
Yeah, because the cash doesn't also come in hundreds. It comes in 1s, 5s, 10s, and 20s. And it's like,
Yes,
my goodness, I didn't know I had to carry this whole briefcase around for a day's worth of work.
Exactly.
Excellent. Yeah. So then, Mel, I used this term earlier, but I really, really mean it in this here because it seems like the biggest question, how do I get a bank account? Could you help us kind of demystify the process of getting a cannabis bank account? For example, what does the average operator need to provide? What does the initial setup look like? And finally, what does an ongoing account compliance or maintenance look like? Is it such a big headache? Is it something that any normal operator can do? Or do you need to hire a new headcount just to manage the money portion of your business? So help us to kind of get some color and context around openings accounts and what does that really look like?
Okay, certainly. So we use a third-party compliance platform that helps us to onboard our customers. It it facilitates that application process. And during that process, we're going to ask for things that you would expect, again, in any industry. If you're opening a business checking account, we're going to want to know your formation, the state of your formation, all of your entity docs, things like that, things that really identify the business. We also have to identify the people who control that business. So, and that's no different than you would expect in any industry. Where it gets a little more detailed is we're going to ask for licensing information. We're going to ask you some high-level questions about how you operate your business, how you handle your cash, how you verify if you're a retail operator, perhaps. How do you verify? Is it age verification? Are you medical only? All of these types of things that allow us to understand your business and how you operate. And so the application process is a little more in depth than you would expect for opening an account to run a snow cone stand, for example. But these are all things that point right back to the Bank Secrecy Act and anti-money laundering. And that helps the bank understand that you are operating compliantly in the state that has issued your license. On a monthly basis, we're going to ask for your sales reports. And that gives us the opportunity to, kind of run some algorithms in the background that say, okay, well, look, Jim says that he should deposit $100,000 in his bank account this month. Yet mysteriously, Jim deposited $500,000 in his bank account this month. What are we going to do about that? So really, it's just a manner of monitoring those transactions and giving us the opportunity to create some transparency and understanding how you run your business.
Excellent. So it sounds like if you have a CPA, someone's already running financial reports for you, like GreenGrowth CPAs, it's an easy just, hey, CC Mel on the documents you already send us every month.
Absolutely. That is perfect.
Yes, cool. And then Lawrence says, are you available in Mississippi and Alabama too? Are you coming up on those states as well?
We are looking at new states in a very strategic manner. So again, if they're not cash heavy, we can easily accommodate businesses in states that I did not mention. However, opportunity, this is a growing industry, as we say, and opportunities are really out there, but we have to do that strategically, because if we do have the cash piece of it, we do not have dozens of branches across the country. And so it's very important to us to be able to have a smooth transition. And if it is a cash heavy business, there's a little planning that needs to go on our part. But we are looking at all of these new areas that are coming online.
Excellent. Well, Mel, thank you very much for kind of enlightening us on cannabis bank accounts, the process of getting those, and a little bit more about Westtown. So again, all the information is in the description of this video for contacting Mel and the rest of the panelists here. Let's go ahead and bring the rest of the panelists back into the chat here. All right, beautiful, y'all. Okay, awesome. So I want to just kind of kick a question out here I saw in the chat I wasn't able to cover earlier. So anyone that's doing the financing or capital raising here, so Jeff, Scott, Dan, what are your typical charges for assisting in capital raising? Do you do a flat fee? Is it based on success? Is it based on a percentage of the money raised? I'll kick it over to you, Jeff, if you want to give some color and context to that. If not, that's fine as well. But let's start with Jeff.
This is very layered. So if it's crowdfunding, it's a straight 7% success fee. There are other fees that go to different vendors to launch your crowdfunding, like the escrow agent or the tech platform. But for us, it's a straight 7% success fee, so nothing upfront for us in crowdfunding. On private placements, in M&A, we generally have some sort of upfront advisory fee. And then there's a combination of a success fee that's based in both cash and in warrants.
Excellent. And then Scott, let's go ahead and do you want to give some color and context on how your fee schedule works for raising capital and helping people out?
Sure. What we do is we charge according to the amount of money that we're raising for someone. And that'll be based on the amount, the difficulty, the type of the assets that we're raising. But it's going to be anywhere from 1.5% to 3% of the amount raised. one-time fee.
Excellent, excellent. And then Dan, if you could help us to get some context on what your fees are and things that you're charging for raising capital.
Sure. No fees up front. We go through a two-stage process of completely pre-qualifying a client first. We're spending real time and money to do so. And once we get to that point, typically within a week or two, we'll issue a formal LOI. And at that juncture, the only money we need to collect is for appraisal, legal, and some underwriting. So that's just a deposit for third-party fees. And at funding, typically we'll charge 3% origination.
Excellent, excellent. And then, yeah, if you want to learn about banking fees and all of that, that's something very nuanced. You should reach out to the bank that you're going to be applying to. So if you want to, you can, I see a question in here for that. So please, Sean, Nicole, go ahead and reach out to Westtown Bank or any other bank you're looking to get depositing with, and you can check out the fees specifically on that. All right, cool. This answers most of the questions I have here in the chat. So let's go ahead and bring Scott Jordan up to the front here, and let's have a little bit of a chat here on all the different things that you've got going on here. Let me see. Yeah, just a quick refresher again. Scott, Alternative Finance Network, working capital loans, equipment financing, and real estate loans. This is a broad spectrum of the types of capital that can be quite handy for cannabis business owners and operators and investors looking to juice up and use some leverage here. So let's get right into the questions, Scott. If you could, please pick one of the types of loan products that you offer, or maybe it's all of them, but help us to better understand maybe the three biggest mistakes you see borrowers make when applying for one of these loans.
I would say, well, let's talk about equipment financing, because I think that's something that so many cannabis business owners need these days.
Yeah.
I would say really it comes down to really three things. The largest three things are, number one, not having a pro forma of what your balance sheet and what your income statement are going to look like. When someone's buying equipment, they're doing it usually for two reasons. One is to make more money. Two is to save money. The third is to perhaps add a new product line, which is going to, again, make them some more money. So you lenders interested in, once you get that money, what are you going to do with it, and how is it going to impact the bottom line? Yep. The lenders are all about the money and increasing profitability and making their investment into your business, because it's an investment in debt, pay off. So I would say that would be one of the first things. Second thing is you want to approach someone in a spirit of cooperation. Oftentimes I see people come with a very arrogant attitude and a very looking at someone in a condescending way and speaking to them in a condescending way. And, that loan officer or that person is there to try to help you. They're not paid by the city or the county or anybody else. You want to approach them in the right spirit, I think. And then I would say probably what really helps is having reviewed financials or audited financials. There's so many people that I see show up with balance sheets that don't balance. And that's a red flag for any lender. So you want to really prepare yourself. You want to present, and you want to provide the paperwork that the lender is looking for, because their goal is to get you the loan, but get a loan that's going to be repaid back. Doesn't pay for someone to make a loan where there's very little chance of being paid back.
For sure, that makes sense, 100%. Thank you for sharing that. So now conversely, let's look at the other side. What are three things that borrowers should do when applying for a loan to improve their chances of successfully securing that type of financing? I know you kind of detailed a few of them on the mistakes and the corollary to that, but are there any other kind of suggestions for the borrowers when applying to increase their chances of success with your group?
I think first, understand where the marketplace is and where you are in terms of the financial picture that you present. If you're losing money, if you are and don't have an event or a story to be able to tell to be able to start to make money, you're not going to get approved by a bank. We have banks and credit unions that are approving cannabis loans for equipment, but they're approving people that prove their ability to be able to repay. So if you're taking on an extra $10,000 or $20,000 a month in estimated expense, you've got to have the profitability or at least the EBITDA to be able to repay that loan. So realize kind of where you are, in that pecking order. I think delivering documents on time. One of the most frustrating things is, it's a lot of paperwork. Again, it's like applying for a home loan times 3, because now it's your business, your personal, and the cannabis portion of what you need. And so have a file together, create a data room where you can easily send out a link for all the documents. Ask the lender or the intermediary, tell me all the documents that I need and let me deliver them to you all at once. If a lender asks for 10 documents, they need 10. Don't deliver them 4 and think that they'll be able to make up the rest. It's one of the more frustrating things that happen, in the industry, and in, being a party that lends to people. And I would say probably, when you're dealing with growers, I think I've probably met over 1,000 of the best growers of weed in the world. Everybody is the best grower, but you can't, there's got to be somebody that's number 2. And I'm looking forward to meeting the second best guy one of these days. Or gal. Okay. If that's you, come reach out to me on LinkedIn, because I haven't met the second best grower yet. But the quality of the product is not the main thing that lenders are looking for. The lenders are looking for the ability to be repaid back, the ability to manage and control your expenses, the ability to report on the important things in the business to secure a profitable relationship where you're repaying your loan on time.
Excellent. And so you brought up that you do real estate loans. Is there, and not every DMA has very expensive, properties. For example, like LA, yes, they're $10-12 million sometimes, but you get out to, what Dan had kind of hit on, like middle of nowhere grow houses, you can get them for like $300,000 or something like that. What is the kind of the minimum deal size for real estate lending, and what is the minimum down that you see, at least through the deal flow that you're looking at and have the appetite for?
So we have started to work with larger deals, and we want to affect the industry in a broad kind of way, because we are starting to lend to other lenders, and we feel that can affect a larger area for pricing to come down for everyone. If we can get people 5.5% money to be able to then lend out at 8 or 9 instead of 13 to 15, we think that it's a better value, for the industry. We work on deals that are $1 million or more, and generally you're going to need 35% down, 40% down. Generally, you're going to get 60 to 65% loan to value in many cases, and the higher loan to value, the higher the rate that you're going to pay, because it's more risky for a lender.
Makes sense. And, I'll bring everybody back in here to answer this question as well. But we just saw the Fed 25 basis points coming up. I'm not sure when they're going to issue that. But this person here in the chat here asks, is that going to have any impact I think we're going to have maybe they say between 3 and 8 rate hikes over this next 12 months. Is that going to affect your ability to lend out, or is that going to change the rates, or do you have that already kind of baked into your model kind of thing for your lending rates?
Do you want me to answer that first then?
Yeah. If you can answer that, I'll bring other people in to answer that as well.
Sure. It will affect rates on the wholesale level, which is where we've been operating recently, where we're lending to other lenders, because it's generally tied to prime plus a margin. In terms of private lenders, I think that they'll probably use that as a reason to increase rates. I think what the Fed is trying to do is get a handle on the inflation that's been going on, and hopefully bring it down a little bit, or at least curb it. And I would expect not to see it lockstep, but I would expect to see it eventually. Rates are gonna go up, because they've been artificially low for 10 years or so. I mean, a long time. I mean, I've been saying for a long time, gosh, I just anticipate rates are going to go up, because we can't keep zero rates forever, and they haven't gone up until now. I think this is the first raise in maybe 8 to 10 years.
Yeah, I think it's trying to inflate the debt, the national debt away, make that go up a little bit so that we can not have to pay back so much. But, I want to bring Jeff and Dan back in. Kind of what are your thoughts on the rate hike, and is that going to impact your business, and how will that materially impact, your business or the people that you're lending to? I'll let either one of you jump in.
Yeah, I can jump in there.
Yeah.
I would go along with Scott. Yes, you will see rate increases. I think probably commensurate with as the Fed raises rates, and we're already starting to see that. Our rates have crept up a little bit. We're still holding at 6.49 for most of our cannabis properties, but we're seeing that creep already. And on the private side with banks, it's a one-to-one naturally because they're borrowing from the Fed. But even with private lenders like us, that affects our cost of capital. Yes. So absolutely, we expect to see that creep up over time. So if somebody is well positioned now to take out a loan, I would get that started sooner rather than later.
Yeah, and then Jeff, anything else you want to add to that?
No, I'll just say, the irony, right, is that we started to see the interest rates coming down on the debt from the historic highs in the predatory lending that was there like 5 years ago, and now it's going to go back up, but it's naturally going back up because just commercials are dictating it. So.
Excellent. And then real quick here, Scott, do you work with finance brokers?
We do.
All right.
We do. Happy to be able to connect with anybody that is looking to take some of my money and lend it to some of their customers.
Excellent. Beautiful. All right. Let me see if there's any other questions here specifically that I had, or if there's anything else that the panelists, if you guys wanted, or guys and gals wanted to throw anything else out there. Let me just run through the chat here, but if you want to jump in with anything, let me just go through here. All right. Let me see. I'm not seeing any specific questions on funding. Let me just put it out there for lending. I know that one of the first questions we got here was, funding for a 500,000 square foot greenhouse in California. I know, Dan, you brought up that you potentially do some of these kind of deals, but they are a little bit more nuclear. You don't want to touch too many of them. They're too far out there. But just wanted to see if you had the appetite for something like that.
Have the ability to do more of those rural properties? Is that the question?
I'm assuming it's going to be a rural property. 500,000 feet in California is going to have to be high in the high desert or somewhat further out there. And look, there's like Rancho or like Cathedral City. It's not like it's in the middle of nowhere, but it's also not downtown Los Angeles. So could you help us to better understand kind of like what is in the middle of nowhere for you? Is it a population size? Is it a distance?
Certainly. And I said it before, it comes down to other properties. So a 500,000 foot property that's 100 miles from anywhere is going to be a challenge because there's no other properties. If that loan goes upside down, it's going to be hard to fill that property again. But as long as it doesn't have to be in a city or right there in the middle of an MSA, but as long as it's reasonably close and there are other properties of similar value around, then I think that's certainly fundable. So the largest is not necessarily a showstopper. And one thing I just kind of put in our chat here that might be helpful is that when you're looking for properties like this, if you're not quite ready for prime time, then consider like a two-step process. First, getting a bridge, get everything buttoned up. By a bridge, I mean a short-term interest-only loan, and then get set up and yourself well positioned before you try to move into that low interest perm loan. The bridge might cost a little bit more on the front end, but since a short period that it's only a year or 2 years long, ultimately it doesn't cost you that much.
Excellent. And then Scott, you brought up here, you want to talk about sale-lease-backs on greenhouses. So could you help us to better understand your thoughts on that, please?
Sure. We have the ability to be able to bring in a funding source that will buy that property, lease it back to you, and you pay rent on it. And so it's a good way to be able to get into a large property that may be in a rural area that you don't expect to receive appreciation on, but your job and your business is to sell marijuana, not necessarily to invest in real estate. And so that's often to do that, particularly if you've invested a lot of money into the property, bought the land, have the equipment there. it's a way to get all of the money out, because the funding source is going to buy that from you for 100% of the value. And so you can take the difference between what you owe and the purchase price to be able to get cash out. That's what a lot of the large MSOs did initially in order to be able to get working capital when there were very, very few sources available for that.
Excellent. Excellent. And then, Jeff, I wanted to ask you a quick question. You know, Purple Peace brings up here, you know, what advice would you give to operators to identify these predatory lenders? You know, you see these very high interest rates or these kind of like roundabout contracts with the social equity groups that were coming through in like the early parts of licensing in Los Angeles. There's a lot of predatory lenders and predatory equity people out there too. So could you help us to kind of get a few key points to identify predatory lending or predatory financiers?
Yeah, I mean, look, first is just what is the ask on their side, right? How high is the interest rate? Are they looking to get equity also into your business? Is there some sort of convert, right? What I like to tell people is, you know, I didn't marry the first girl I dated. Don't take the first deal you're offered, right? Shop it around and get some other quotes, right? So.
Excellent, excellent, cool. Thank you for that. Yeah, I mean, really about the ask and what is the relative thing that you're seeing here, and is there any other better options? If not, I mean, you might be stuck and you may have to take a bad deal if you really, really, really want to open up that business. But Dan, I'll let you take this question here from Spin Capital, but let me read it out here to the group. How can brokers most effectively qualify and do their due diligence on a cannabis business before sending it over to a lender to make sure that they're sending over a quality deal? So Dan, I'll let you take over that one.
Yeah, thank you. That's a great question. And if it's bridge, the revenue may or may not be as important as the property. But if you're looking at a lower interest loan, just look for that solid historic revenue. It can be leasehold that revenue if that property is leased out to a third party, or if it's owner operated. Just that, ideally at least 12 months of solid revenue. As I mentioned before, a property that can be used for other purposes. But if it is owner occupied, try to get those taxes and financials ahead of time. For any owner that owns more than 20% of the business, because they're probably going to have to be a personal guarantor, I would find out what their FICO scores are, their net worth and liquidity, so you can create an entire package and put that together. If it is leased out to a third party, see if you can get a copy of that lease. Is it a long-term lease, or is it expiring in 6 months? Because these things are going to matter. And again, when I talked about comps, do your research a little bit ahead of time. Even if you just talk with a local realtor and find out what similar properties rent for, what similar properties sell for, the more you can put together a cohesive package like that, the higher likelihood your loan's going to fly through.
Excellent, excellent. Thank you very much for that. Any last questions? We're getting to kind of the end of our presentation here. So if you have any last minute questions, drop those into the chat. Also, I'll open it to the panelists. Is there anything else that I haven't covered that you'd like to share with the viewers to add value in any one of your respective discipline? All right, seems like we covered a lot of stuff here. So I'll wait for any last things to come in through the chat, but I will do a little bit of a closing here. Again, thank you to the viewers and to the panelists for joining. If there are any questions that we did not get to due to time constraints, then my deepest apologies. I apologize for that. But to learn more, again, about the presenters and their companies and the services that they offer, we put all the contact information in the YouTube video description. You can visit their website, send contact messages through there, or find them on LinkedIn and message them there. But everyone has access to their website. Again, please do visit their website, find the benefits of working with them, and again, reach out to them. But I'll check here for any last questions. I don't see anything. Let me see more here. All right, one more is here. Is that there's a step-by-step template.
Am I muted? Yeah.
Oh, no, I got you.
Am I muted? Go ahead.
Got you. So is there anything else? There's a question here.
Yeah. So what I was going to say was I had myself on mute before. I couldn't unmute myself. In terms of brokers, working with funding sources, I think one of the things that brokers can do is present a one-pager to a lender. We're all busy. We don't want to get a email in with 10 files and no idea of what someone's asking for. It's just a waste of time. I have a form that I use, for brokers to be able to gather the information. I'm sure Dan probably has a form as well. Gather the information, give us a short overview of what it is that the borrower is seeking and the main points, the financials, the other financial information. That would go a long way towards moving you up in the food chain in terms of getting answers and getting the funding that you're seeking for your borrower.
Yeah, make it easy for the borrower to understand what you're asking for. Because you get a bunch of emails every day, it can become a mess. But to the person sending it, they're like, "Oh, it's a layup." But make it a layup, okay? Don't make it I have to walk the ball down the court. But Dan, so you wanted to address this question here. Is there a step-by-step guide or template for funding that they can go by?
Yes, one thing I recommend first is what not to do. Don't just send a whole boatload of attachments, literally labeled IMG 47, IMG 48. All you do is frustrate the heck out of the lenders. And instead, if it helps, I have a template I can send out. It's literally about 24 questions. You just get those simple answers to the questions, and that will help you organize your thoughts and make a great presentation. But I can't emphasize enough, just don't send a whole bunch of junk to a lender, because you'll lose your opportunity to make a good first impression. Only send them what they're asking for coming out of the gate.
Excellent. All right. Well, that will wrap up our presentation here. This has been 1 hour of great back and forth. I appreciate the panelists and the viewers. Thank you very, very much for your time. Panelists, I'll have you stick around for just a moment. But again, everybody else, have a great day, and we'll talk to you soon. Bye-bye.